Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Circle Internet Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. And if you want to level up your charting with visual tools, the VIP Algos link is below in the description. But for today, we are unpacking a really wild market paradox, right?
Oh, absolutely.
Well,
It's one of the most fascinating setups in the digital asset space right now.
yeah, because, imagine a company that's growing its revenue by over 51% year over year. I mean, in today's market, most tech executives would trade their left arm for that kind of top-line explosion.
Right, they'd kill for it.
Exactly. But then you look at the stock for Circle, ticker CRCL, and it's currently down 75% from its 52-week high.
Yeah, which just breaks every traditional mental model of how financial gravity is supposed to work.
It really does. So how can a company be growing revenue so aggressively, again, that massive 51.46% jump, while the market just brutally punishes the stock? I mean, it's trading around $65.69 today, which is miles below its peak of nearly $263.
Well, to crack that, we have to kind of completely change how we think about what Circle actually does. Because when people hear digital asset company, they immediately assume it's a software business, with those 90% software margins.
Right. They think they're just selling code.
Exactly. But Circle's core engine isn't just code. Their primary revenue is actually heavily tied to traditional finance, specifically the interest they earn on U.S. Treasury bills and the cash deposits sitting in the bank that back every single USDC stablecoin in circulation.
Let's break that down for a second, because that mechanism is kind of the key to everything here. When you buy one USDC, you hand over $1 to Circle.
Yep, exactly $1.
And then Circle takes that dollar, puts it in a reserve, and maybe buys a short-term Treasury bill yielding, say, 5%. But the person holding the USDC token gets 0% yield, right?
Right. The user gets 0, and Circle keeps that 5% as revenue. That is the magic of the stablecoin business model. I mean, they are managing $40 to $50 billion in yielding assets.
Which is just a massive pile of money.
It's huge. And as the circulating supply of USDC grows, and as long as, macro interest rates stay elevated, Circle's revenue scales up with basically zero marginal cost for each new token they mint.
But this is the structural reality of how they hold those billions and who gets a cut of that interest is what's dragging down the stock right now.
Exactly, which takes us straight into the structural overhaul happening under the hood. Circle just achieved something totally unprecedented. They became the first U.S. digital asset company authorized to directly manage their stablecoin reserves under a federal trust bank charter.
Wait, a federal charter? So they're essentially a bank now.
Basically, yes. It's a monumental shift. Because before this charter, Circle couldn't just park $50 billion at the Federal Reserve. They had to use traditional third-party custodial banks like a BNY Mellon to hold those assets.
And those banks don't work for free.
No, they definitely don't. They charge fees. They take a slice of the pie. So by securing this Federal Trust Bank charter, Circle is effectively building the regulatory architecture to become its own custodian.
Okay, so it sounds like they just bought the most expensive, highly regulated vault in the entire world. But when you look at the fundamentals, the trailing 12-month net margin is negative 2.76%.
Yeah, the margins are bleeding.
Right, and the earnings per share is negative $2.91. If they're operating at a massive net loss just to build this vault, aren't they just burning cash to look legitimate to regulators?
Well, Wall Street is asking that exact same question. And honestly, that is why the stock took a 75% haircut. Building a federally chartered trust bank requires a staggering amount of upfront capital.
Like compliance costs and things like that?
Oh, everywhere. We're talking elevated operating expenses from their recent IPO, massive investments in compliance infrastructure, and aggressive global headcount expansion just to meet those federal standards.
So short-term investors see those negative margins and just hit the sell button.
Exactly. But long-term institutional players look at that same charter and see an impenetrable moat.
Because once the vault is built, no competitor can easily replicate it.
Precisely. Any new stablecoin startup would have to spend years and hundreds of millions of dollars just navigating the exact same federal gauntlet. And once Circle fully transitions its reserves in-house, they completely eliminate those third-party custodian fees.
Okay, so it's a multi-year play designed to dramatically expand their net margins over the next, 4 to 6 quarters?
Yeah, roughly that timeline. But as you pointed out, the immediate reality is that they are bleeding cash, And it's actually not just internal spending squeezing them.
Right, there's that external headwind too. The whole thing with Hyperliquid, I've seen it described as a prisoner's dilemma for Circle's revenue. What is actually happening there mechanically?
So Hyperliquid is a major decentralized trading exchange. And because the crypto ecosystem is incredibly competitive right now, these exchanges hold a ton of power. They go to Circle and say, hey, we'll bring billions of dollars in trading volume to USDC, which grows your market cap.
Which Circle obviously wants.
Right. But, the exchanges say, in exchange for giving your token all this utility, you have to share a percentage of that back-end treasury interest with us.
Oh, wow. So it's a massive revenue sharing squeeze.
It really is. I mean,
Hmm.
historically, Circle has shared yield with major distribution partners. Like Coinbase, for example, has historically retained about 50% of the USDC interest revenue generated on its platform.
Which is already a huge chunk.
Yeah, and as new aggressive players like Hyperliquid demand their own cuts, Circle's slice of the pie just gets thinner and thinner. It actually reached a point recently where JP Morgan analysts explicitly cut their earnings forecasts for Circle, citing this exact dilution of their revenue economics.
I mean, you can see why Wall Street is terrified. You have the massive upfront costs of the federal charter crashing head-on into these new revenue-sharing demands. It creates this total tug-of-war in market sentiment.
Yeah, analysts are completely divided right now on whether this company is a sinking ship or, a sleeping giant.
Let's look at that divergence because it's extreme. On the bear side, you have Dan Dolev at Mizuho issuing this really aggressive downgrade. He recently dropped the stock to underperform and slashed his price target to $50.
And his thesis isn't just about the margin squeeze either. He's pointing to intense pressure from competing stablecoin initiatives.
Right, the OpenUSD project.
Exactly. OpenUSD is essentially a consortium backed by rival tech and finance giants. They're trying to create this universal, interoperable standard for digital dollars. So the fear is, if a rival standard gains traction, Circle could lose its dominant market share.
And compounding that bearish narrative is a huge wave of insider selling. Over the last 90 days, there's been a net of 2.1 million shares sold by corporate insiders. That's 38 buys compared to 182 sells.
That's a lot of red on the ledger.
Okay, let me pause you there, though. Because if you're an everyday investor looking at this and you see the people inside the building rushing for the exits to the tune of 2 million shares, that sets off alarm bells.
Oh, 100%.
But then you look at the other side of the trade. Cathie Wood and her ARK ETFs are aggressively accumulating more CRCL shares. They're treating this 75% drop as a total fire sale. So why should anyone trust the institutional whales when the insiders are literally cashing out?
It's the classic anxiety of public markets, for sure. But we really have to look at the mechanics of post-IPO insider selling. When a company finally goes public, you have founders, early employees, venture backers, people who have had their entire net worth locked up in a highly illiquid asset for 5 to 10 years.
Right, they just want some liquidity.
Exactly. When the lockup period expires, they want to buy a house, pay for college, or just, diversify their portfolios so they aren't totally dependent on one single stock. It doesn't automatically signal a lack of faith in the underlying business.
Okay, so it's less like builders abandoning a sinking ship and more like the construction crew finally cashing their paychecks and going home while the long-term landlords move in to collect the rent.
That is a much, much more accurate way to frame it.
Yeah.
And the landlords, these institutional whales like ARK, are buying because they see the infrastructure validation happening in real time. Just look at the recent milestone with the DTCC.
The Depository Trust and Clearing Corporation. For anyone unfamiliar, they are essentially the invisible plumbing of the U.S. stock market. Like if you buy a share of Apple on E-Trade, the DTCC is the entity that actually clears and settles that transaction behind the scenes.
Right. And historically, that settlement takes time, usually 1 or 2 business days. But recently, the DTCC facilitated a massive live tokenization trial. Giants like JP Morgan, Goldman Sachs, BlackRock, and nearly 40 other institutions successfully completed live trades of tokenized stocks and treasuries directly on a blockchain.
Where settlement is instantaneous.
Instantaneous and borderless. But here is the critical part. When you trade a tokenized stock on a blockchain, you still need a cash leg of the trade to settle against it. You need a digital dollar.
And that's where Circle comes in.
Exactly. USDC is positioning itself to be the primary settlement currency for these massive institutional on-chain transactions. As Wall Street moves trillions of dollars toward blockchain settlement, Circle isn't just a crypto company anymore. They're basically becoming the de facto digital dollar rail for the entire global financial system.
Which explains why the stock is showing signs of life again. I mean, the price has stabilized around that $65.69 mark, and we even saw a 4% intraday bump today. It seems like the market might have finally absorbed all that post-IPO de-risking and selling near the $50 to $55 base.
Yeah, the selling pressure is likely exhausting itself at these levels, but because of this intense battle between the bear narrative of margin compression and the bull narrative of institutional adoption, the stock is just violently volatile.
Yeah.
The beta on CRCL right now is 2.307.
Which is huge, meaning if the S&P 500 drops 1%, Circle could easily drop 2.3%. And if the market rallies, Circle rockets up more than twice as fast.
It creates an absolute whiplash environment. And when traditional valuation metrics get this murky, both retail investors and institutional traders lean really heavily into technical analysis to find a floor.
So let's talk about those technicals, because we're seeing CRCL attempt to form what chartists call a double bottom base near its February low of $49.90. And interestingly, the trading volume is up 1.17 times the 3-month average.
That volume metric is so crucial. A stock stabilizing on low volume doesn't mean much. It just means people stop selling. But stabilizing on higher than average volume, that suggests genuine accumulation.
Like big buyers are stepping in.
Exactly. It means serious buyers are stepping in at these price levels to absorb the remaining sell orders.
Now, navigating a stock with a 2.3 beta is incredibly chaotic. The price action moves so fast that retail and technical traders often rely on visual software to make sense of the noise. And this is where we frequently see traders using educational indicator suites, like the VIP Algos tools available on platforms like TradingView.
Yeah, when you're dealing with rapid algorithmic price swings, visual data organization really becomes a survival tool. What these indicator suites do is mathematically analyze price and volume data to provide visual cues right on the chart.
They highlight trends and support zones, right?
Exactly. They highlight the overarching trend direction, map out historical support and resistance zones, and help traders visualize potential take profit and stop loss areas. They're used across the board, from high beta stocks like Circle to crypto and even Forex markets.
But I want to throw a major caution flag here and frankly push back a bit on the reliance on these tools altogether. Because factually, we have to state that these are strictly educational chart analysis tools. They do not place trades for you, they are not financial advice, and they absolutely do not guarantee any kind of profit.
Right. They're just tools.
And honestly, with a stock like Circle that is reacting to analyst downgrades, hyperliquid partnerships, and Washington regulations on a daily basis, doesn't relying on a chart indicator give traders a completely false sense of security? It feels like using a compass in the middle of a hurricane. The compass might perfectly tell you which way is north, but it's not going to stop a flying tree from hitting you.
That is a perfect analogy, and any veteran trader would agree with you. Technical indicators do not predict the future. They only visualize the probabilities of past and present data. A brightly colored support line on a TradingView chart cannot predict a surprise interest rate hike from the Fed.
No, definitely not.
And it certainly cannot predict a sudden geopolitical crisis.
Which means, if you are trading this, risk management isn't just a buzzword, it is literally the only thing keeping you in the game.
Exactly. The indicators are just the compass. You are the one who has to navigate the storm and manage your exposure.
And there are some massive macro storms brewing on the horizon that are going to dictate where this stock goes next, far beyond what any technical chart can predict. So let's talk catalysts, starting with the political landscape.
Right. Because the lack of a clear regulatory framework in the U.S. has been a dark cloud over this entire industry for years. But there is serious legislative momentum building right now with the Clarity Act.
Looking at the reporting on this, President Trump has been actively urging the Senate to push this legislation through, and the framing is fascinating. He is explicitly tying domestic crypto regulation to the broader U.S.-China artificial intelligence and technology race.
Yeah, the argument is basically that financial innovation is a matter of national security. If the Clarity Act passes, it finally establishes a comprehensive, formalized rulebook for digital assets in the U.S.
Which would be huge for Circle.
Massive. For a company that has already spent a fortune securing a federal trust bank charter, this legislation is the ultimate tailwind. It validates their entire expensive, compliance-first business model while basically pulling the ladder up on cheaper, unregulated competitors.
But domestic politics is only half the macro picture, right? We also have to look at the escalating geopolitical risks. As we record this, the U.S.-Iran military escalation is entering its 5th consecutive day of strikes.
which is a very tense situation globally.
Right, and when traditional markets see military conflict in the Middle East, they panic. Energy prices spike, supply chains get threatened, and investors trigger a massive risk-off rotation. They dump speculative high beta stocks. Since Circle has a beta of 2.3, traditional logic says it should get absolutely hammered in a broader market sell-off.
Traditional logic would dictate exactly that. But digital assets introduce this really fascinating counter-narrative known as the dollar proxy thesis.
Walk us through how that actually plays out on the ground in a conflict zone, because the idea that a digital asset company benefits from global warfare sounds incredibly counterintuitive.
It does sound strange at first,
Yeah.
but imagine you are a business owner or a citizen in a region where the traditional banking infrastructure is suddenly threatened by military strikes.
Hmm.
Physical bank branches close, ATMs run out of cash.
You literally can't get to your money.
Right. And capital controls might be instituted by the government, meaning you cannot wire your life savings out of the country. In that scenario, capital instantly searches for an accessible safe haven.
And physical US dollars are hard to smuggle through a border checkpoint.
Exactly. But a digital token that is mathematically pegged to the US dollar, sitting on a secure app on your mobile phone, that is completely borderless. It cannot be easily confiscated by local authorities.
Wow, so people just flock to it.
Historically, yes. Geopolitical instability drives a massive surge of capital into decentralized assets. But people fleeing conflict zones don't want the volatility of a floating crypto token like Bitcoin. They want the stability of the dollar, so they flood into USDC.
That is wild. So while Wall Street is panicking and selling equities, global citizens are rushing to convert their local currency into USDC, which means Circle has to mint more tokens, manage more treasury reserves, and ultimately collect more interest revenue.
It's a dual-edged sword. The stock might suffer short-term volatility from a broader equity market panic, but the core fundamentals of the business actually strengthen as global adoption of their product accelerates just out of pure necessity.
And the market is going to demand proof of those fundamentals very, very soon. Q2 2026 earnings are fast approaching. And this isn't just another quarterly report. This is Circle's first full quarter operating post-charter approval.
This is the ultimate inflection point right here. The market needs answers. Have they stopped the bleeding on the operating expenses? Are the costs of managing those reserves finally starting to decline now that the federal architecture is in place?
Because if they haven't,
Right. But if Circle can demonstrate that USDC circulation is growing and that the promised margin expansion from the charter is actually materializing, it could entirely rewrite the narrative surrounding the stock.
we have covered incredible ground today. We started with the sheer paradox of 51% revenue growth paired with a 75% collapse in share price. We mapped out the brutal, expensive reality of building a regulatory moat from scratch.
And we looked at that crazy tug of war between insiders taking profits and institutional whales just backing up the truck.
Exactly. Plus, we explored the volatile technicals and the massive macro catalysts, from Washington legislation to Middle East conflicts. So, boiling all of this down, what is the final verdict from our research today?
So the current rating assigns Circle a 7 out of 10 bullish score. However, they are very clear that this is a contrarian, catalyst-driven position designed for a 6 to 12-month horizon.
Yeah, this is not a day trade.
Not at all. It requires a strong stomach. You are actively weighing the upside of an unreplicable federal trust bank moat against some very real near-term margin pressures from aggressive competitors. But the data concludes that at current price levels, the risk-to-reward ratio is heavily asymmetric to the upside, provided an investor sizes their position properly to account for that violent 2.3 beta volatility.
Why does all of this matter to you? Well, maybe you're a traditional equity investor who usually sticks to index funds, or maybe you're a hardcore technologist living entirely on the blockchain. Regardless of where you sit, the merging of federal banking regulations and digital dollars is fundamentally rewiring the plumbing of the global financial system right before our eyes.
We're watching the architecture of the next decade of finance being built in real time.
And Circle has positioned itself directly at the center of that new architecture, which leaves us with one final, slightly provocative thought for you to take away today. We've talked extensively about Circle building this impenetrable regulatory moat with the federal government, right?
Yep, they are dug in deep.
And we've talked about them seamlessly integrating with the ultimate titans of traditional finance, like BlackRock and the DTCC.
The institutional adoption is just moving at breakneck speed.
So consider this scenario. If Circle continues down this exact path, continuously embedding itself into the fabric of traditional finance with the blessing of federal regulators, Could a private company's stablecoin effectively become the United States' actual central bank digital currency by default?
Oh, wow.
Like, could Circle render any future government-built digital dollar completely obsolete before the government even figures out how to launch one?
That is a profound question. I mean, if the private sector builds a cheaper, faster, and more efficient digital dollar infrastructure, the U.S. government might find it far more pragmatic to simply co-opt and regulate it rather than trying to reinvent the wheel from scratch.
It really makes you reconsider how we measure the health of these frontier companies. We started today talking about how financial health is usually clean, binary, and easy to read. But as we've seen with Circle, when you are trying to diagnose the future of money itself, you have to be willing to swim in some deeply murky waters.
But those murky waters are often where the greatest generational opportunities are hiding in plain sight.
So true. Just a quick reminder, if you want to explore the technical tools we discussed, the VIP Algos link is below in the description. Thanks for joining us for Smart Wealth with Joshua. Don't forget to subscribe, and we'll see you next time.